Reliance Industries delivers its best ever quarterly performance. Profits rise over 22% sequentially, gross refining margins at a 2-year high, and that offsets weakness in other segments.
Bear sees control on the Wall Street as equities fall for the third straight day. Nifty sheds 100 points. The Sensex nears 28,000 after losing 640 points in just the last 3 days.
A sea of red across global markets. Fears of a Greek default in China's move to allow short selling in more stocks triggers panic. Wall Street sinks at open. Deep cuts seen across Europe. Bond yields in Germany near 0% as investors park their money in government debt.
A sharp increase in gold imports and a slight uptick in oil imports pushes up the trade deficit for the month of March by almost $6 billion. That comes in at $11.79 billion. This despite exports growing by nearly $2 billion.
The process to file tax returns just got more complicated. The government seeks more details from individuals, makes it compulsory to declare any foreign trips and earnings from any foreign assets in the new income tax filing forms. This is seen as a move to crack down on black money.
Some relief for FIIs in the 40,000 crore rupee MAT tussle. The government allows FIIs to avail benefits under the double taxation avoidance agreements. FIIs from Singapore and Mauritius may get a reprieve. That's a CNBC TV 18 exclusive.
A shot in the arm for Glenmark Pharma. Temasek to invest 945 crore rupees in the company through a subsidiary will help Glenmark pare its debt burden.
After Cleartrip and other partners pull out of Facebook's Internet.org, Mark Zuckerberg defends the initiative, says net neutrality cannot be used to deprive people of Internet access, and Airtel CEO writes to employees defending Airtel Zero.
Tax Department opposes Nokia's plans to sell its Chennai plant and drops a bombshell, says the company's tax dues could amount to 10,000 crore rupees. The court asked the tax man to consider the auction route and appointed independent valuer.
Lenders tighten the news around Vijay Mallya's UB Holdings. United Bank is set to declare the company as a willful defaulter for the second time over a 150 crore rupee loan given to Kingfisher. That's an exclusive.
If you'll take the longer-term view, I said this, I absolutely believe that the future lies in the developing market.
The non-executive chairman of Hindustan Unilever is optimistic about growth revival, says developing markets is where the future is for consumer goods companies. That's a CNBC TV 18 exclusive.
And it's a major shake-up at Penguin Random House as its editor Chiki Sarkar decides to call it quits. 4 other top executives also quit India's largest publishing house.
It's not about shouting.
While Mumbai Indians have lost 3 matches in a row, can they stop the rot, or will Chennai continue its winning streak? Well, Chennai has the upper hand, at least at the moment. Good evening. Thanks very much for joining us on India Business Hour. I'm Nantara.
Good evening, Shireen. All I can hope is that I hope the IPL turns out to be a clean tournament, no spot fixing, no match fixing, no betting, none of that stuff, and that Saurav Ganguly becomes the coach of the Indian team.
All right, so we know who's getting your vote. But on that note, it's time for us to kick things off with the day's trading action. For the third straight day, the Bears managing to keep the Bulls at bay on the Lal Street. What started out as a sluggish day took a turn for the worse in the last hour as losses accelerated. This is what we've seen play out in our markets over the last few trading sessions. The Nifty lost 100 points. The index is now just above the 8,600 mark. The Sensex lost about 220 points. It continues to move towards the 28,000 level. Mid-cap saw some deep cuts with the index losing about 200 points. But we're not alone. It's a sea of red as far as the European markets are concerned. And this is on account of fears that Greece may not reach an agreement with its international creditors in time for the Eurozone finance ministers meeting, which is on the 24th. So look at the FTSE, it's down 1%. The CAC is now down about 1.5%. And look at what's happening in Germany. The DAX now closer to a 3% cut today. There's also worrying news coming in from China, which has allowed fund managers to lend shares for short selling. It will also expand the number of stocks that investors can short sell in an effort to raise the supply of securities in the market. That's had an impact on global equity markets as well. Traders hinting that markets had sold off sharply due to speculation that the Chinese government had asked investors to take froth out of the market.
And those kind of comments from China, as well as the crisis in Greece, is driving money markets and into German government debt. Yields on benchmark 10-year bonds fell as low as 0.051% from a close of 0.085% on Thursday. This has led to speculation that Germany could become the first Eurozone country to have a 10-year bond with a negative yield. And across the Atlantic, a quick check on Wall Street, we saw markets open with sharp losses. Deep cuts is what we had seen. We'll bring up the frontline indices for you so you can see how they're doing at the moment. The S&P right now made a bit of recovery, down 21 points, but look at the Dow. That's down 250 points. The Nasdaq also down by almost 72 points in trade. And Shireen, all of those with Bloomberg trading terminals today had a bad day in trade.
Well, that's right. They did witness a shutdown and an outage across Asia and Europe. The company confirming to CNBC that its terminals were unavailable worldwide. Traders from the UK and Singapore complaining on Twitter that they'd been affected by the issue. The Financial Conduct Authority in UK has said it's looking at the fallout from the disruption for firms it supervises. Of course, Bloomberg is a competitor for CNBC TV 18. But let's get to the big story back home. It's a good performance from the refining business, which has helped Reliance Industries deliver its best ever quarterly earnings. Gross refining margins at a 2-year high, and this has managed to offset the weakness in other segments. Anuj is standing by now with the details. Anuj, it looks like a solid performance there from Reliance Industries.
Solid performance. It's for the record, it's the best quarter that Reliance has delivered. But I would still fall short of calling this a blockbuster performance, because the stock has rallied already, and quite a bit of this could be in the price. If you take a look at the net profit standalone, that's close to 6,200 crores. So that's gone up about 23% quarter on quarter is what we have for Reliance. The gross refining margin of $10.1 per barrel is at 2-year high. The market was going with expectation of about $9.9 per barrel. If you take a look at the other businesses, though, there is a bit of underperformance. You have Petchem business, which has seen a bit of decline, 3.7% quarter on quarter. Refining business, of course, has gone up 32% because of that gross refining margin, and that's what's making up for disappointment everywhere else. Apart from that, if you take a look at the consolidated number for Reliance, the net profit is 6,400 crore, up 18%. Oil and gas EBIT consolidated down 68% to 330 crore quarter on quarter. That's mainly because of shale business. That was one concern that analysts raised, and that's something that we'll have to talk about later. In terms of other important parameters to watch out for, FY15 EPS of 80 rupees now. Keep in mind, the stock is up 12% this month already. So Monday morning, the consensus was that the stock will still rally because the numbers are quite good. But it will be interesting to see if there is any further re-rating based on these numbers, because it's already been a market leader and quite a bit of this is already priced in. Also, keep in mind, the standard disclaimer will flash on the screen. Reliance has taken over management control of both TV 18 and Network 18, the companies that own the channel that you watch.
Thanks a lot, Anuj, for joining us with those details. And how are analysts reacting to Reliance's fourth quarter earnings? Well, Sudeep Bandapadhyay of Destiny Money Security feels RIL probably posted the best set of quarterly numbers, and Mayuresh Joshi of Angel Broking said refining has been the shining star. Listen in.
GRM margins were expected to go up because of what was happening, a lot of planned and unplanned shutdown in refineries globally, and the cracking spread has been increasing. So it is expected. A good set of numbers, probably the best ever numbers for Reliance in a quarter.
Clearly, I think on the GRM front, we were expecting around $10, so that is a slight beat on that front. Petchem was always expected to be a little bit subdued because of the fall that we've probably seen in product margins. But clearly, refining has been the shining star for Reliance, as was expected. So I think numbers more or less in line with estimates. But again, I think on the bottom line, it's been a clear beat as far as we were concerned. So I think it has exceeded expectations in terms of both GRMs and the bottom line.
All right, so the street likes what they've heard from Reliance Industries. Let's stay with earnings. The TCS stock fell 4% in trade today, mirroring the disappointment over the company's muted performance in the fourth quarter. While the management remains confident on the business outlook for the current year, brokerages are pruning their estimates. Kritika Saxena has more.
TCS's dream run on the earnings highway has hit a speed bump. Q4 has been the third straight quarter in which the IT giant missed performance expectations. Analysts are now getting impatient and earnings downgrades have flown in thick and fast. Following the subdued Q4 show, CLSA downgraded its target price on the stock by 2%. JP Morgan maintains a neutral rating. The firm says the gap between expectations and numbers, which began to open up in the second quarter of FY15, has further widened in the March quarter. Citi too has trimmed its FY16, FY17 estimates by 2 to 3% and lower target price to 2,640 rupees per share. The management, however, remains unperturbed, saying the company's performance has been quite decent given the volatility in the market. MD and CEO N. Chandrasekharan also strikes an optimistic note on FY16.
TCS today, in terms of capability, in terms of people, talent, intellectual property, market positioning, is in a much better position to capture many of the opportunities that we couldn't have done several years ago. So given all this, there is no reason why TCS should continue to perform exceedingly well.
We're going into FY16 in a scenario which is very similar to the way we went into FY15. The overall business environment is positive. There is a technology imperative. There's a proven technology out there which is getting well accepted in our client base.
TCS, like most IT giants, has its hopes pinned on digital technologies boosting growth in the coming year.
Discretionary spend on digital will increase almost in every customer that we work with. Some will have funding for that. Some will be trying to take cost out from their current portfolio of IT spend. Every discretionary spend in every business will be predominantly digital. Let me put it that way.
The fourth quarter performance by India's largest IT outsourcing company has placed industry watchers on the edge. Analysts now remain cautious with respect to expectations from other big IT giants as well. In Mumbai, Kritika Saxena.
A muted performance by TCS. But let's move away from earnings corner. Trade deficit in the month of March has widened to its highest level in 4 months. A sharp spike in gold imports is the main culprit. Lata Venkatesha joining us with those details. Lata, should the government be worried? Is this trend likely to continue?
Gold imports is one big reason why we have a fairly smart jump in the trade deficit. Trade deficit has gone up from around 7 billion to around 12 billion. So it's a 5 billion increase. And that 5 billion increase, about 3 billion is accounted for by gold itself, which has risen from 1.98 to 4.98. So, 3 billion coming in from there. Then it's not very difficult to explain the others. Usually in March, imports and exports jump because people want to finish for the year end. It's a strong month anyways in terms of economic growth. So that explains why you have got this very big jump in non-oil imports as well. Oil imports itself have jumped from 6.1 billion to 7.4 billion. But non-oil imports have also seen a very smart jump from 22.3 billion to 28 billion. That is comparing month on month. In February is anyway lower in terms of number of days as well. Exports have jumped from 21 odd billion, 21.5 billion to 23.5 billion or nearly 24 billion, but not quite commensurate with the jump in non-oil imports. It's not yet a cause of worry at all. Trade deficit around 11 billion a month can be managed if we don't have that big gold jump, which my sense is because of Akshaya Tritiya, which falls in a few days. If it is controlled to probably around 2-3 billion, then we should be getting a trade deficit tick of around 10 to 11 billion, which is not at all worrisome. It will still mean a 1% current account deficit at the end of the year. Other things being the same in terms of software exports. The other point to note within the exports data itself is that 3 of our traditional and more importantly value-added exports have not been hurt despite the fact that the world is a much more debilitated place. Middle East is a big destination of our exports. It's extremely weak. Russia is a little bit of a destination of our exports. China is a big destination for our exports. All these are countries that are experiencing slower growth. and some of them terribly slower growth. In spite of it, textiles had actually grown by 2.5% year-on-year comparison. Engineering exports have grown by about 2.5%, and drugs and pharmaceuticals are almost stable. These are our big value-added exports, and they have not done too badly. So I would think that despite the month-on-month jump in trade deficit, this is not a worry area at all. We can live with this.
Well, that's right, Lata. In fact, that is what our sources in the government are saying as well. And in fact, they expect the April number to also continue to see a spike as far as gold imports are concerned, and that's largely on account of Akshaya Tritiya. Now, India's recovery will be a slow and steady process. Moody's Analytics, a group company of global ratings agency Moody's, expects India's GDP to grow by 7.3% in 2015. That's marginally higher than the 7.2% figure in 2014, but this is well below the IMF's projection of 7.5% and a similar estimate from the World Bank for the current financial year. Moody's Analytics expects growth to pick up in the years to come if oil prices stay benign and investments start to pick up when interest rates start to trend downwards. Now, the government could provide some relief to foreign institutional investors over tax demands. The centre is seeking nearly 40,000 crore rupees from FIIs by levying the minimum alternate tax or MAT on capital gains that they made over the years till March 31st. Now, sources say FIIs will be allowed to avail benefits under the double taxation avoidance agreements that India has signed with select countries. Sapna Das joins us now with the exclusive details. Sapna, you know, in your conversation with the Revenue Secretary just 24 hours ago, he had said very clearly that this will be dealt with on a case-by-case basis depending on the DTAs that have been inked. So at least there is a silver lining, a window of hope for select FIIs from certain territories.
Absolutely. In fact, the point that the government is trying to make here is that the fact that the treaty benefit will be available should never have been in doubt. So what they're saying is that they can go ahead and avail those benefits under their respective DTAs, whichever FII has been served with a MAT notice. The only point is that the investors will have to come and claim the benefit. It's not that the government provides it on its own. The investors will have to step forward and claim the benefit. The other aspect is that why it was never in doubt, that's the impression that we have gathered from the government, was because of the fact that there's a certain clause in the Income Tax Act which says that if taxpayers so desire or if entities so desire, they can avail a beneficial or a different tax treatment in terms of the respective DTAs. So basically this question is not in doubt at all. Now this is going to be very, very beneficial, or rather this is a very positive development for all those investors. Most of the FII investments which come from come under the Mauritius Treaty or the Singapore Treaty or even the Netherlands Treaty, those are the heavy areas. Those are the people who can actually now go ahead and claim some kind of a relief on the MAT notice that is served. Basically, especially in terms of the Mauritius Treaty investors, they don't pay a single penny in capital gains tax here in India. So when you're not paying anything in capital gains tax, the same logic should apply to MAT as well.
All right, I don't think that there's going to be a problem for FIs wanting to claim these benefits. I think we're going to have quite a queue there lining up to claim those benefits under various DTAs. But the other story that you're tracking, and this is important for all of us, Sapna, let's talk about the new forms to file tax returns. The process seems to be getting even more complicated.
Well, complicated, but tedious, and also the fact that the disclosure norms have been made extremely stringent. And this is not only in the case of people having foreign assets abroad, but this is also some of the disclosure norms have also been tightened for resident individuals or the small taxpayers, people who don't have a huge income here in the domestic territory, but they'll have to make all kinds of disclosures. Coming back to the issue of residents and not ordinary residents, well, here earlier also they were supposed to declare their foreign incomes, the kind of foreign bank accounts that they have, the assets they have. But now the government is saying that for the financial year 14-15 onwards, which means assessment year 15-16, starting from the month of July onwards, when you have to start filing the returns, you'll have to also declare the income that you earn on your foreign assets. So that's a big change. Why just income on foreign assets? Also foreign travel, details of foreign travel and the expenses that you incur on that. Domestically, well, here all the bank account numbers will have to be mentioned in the return form. Also the balances that those bank accounts have during the financial year that you'll be reporting on, all of that will have to be mentioned. So this is going to probably ignite a big discussion in the industry and among various taxpayers. The government as of now is silent on why this kind of a tax policy, or why this kind of a change in the policy orientation has happened.
Okay, let's try and find answers to those questions that you raised. Divya Bhaveja, the partner at Deloitte Haskins, joins us now to talk more about these new tax return forms. Divya, appreciate you joining us. We understand the logic because they want to align this to now the new black money bill that is going to come into effect. You know, there's nothing subtle, or at least there doesn't seem to be anything subtle about these forms anymore.
Hello, Sapna, I can't hear you. Can you just... Hello?
Yeah, Divya, is my voice getting through to you?
Yeah, it's better. There was in the voice.
Yeah, so I was asking you the logic. We understand they want to align this to the new black money bill that is going to be cleared by Parliament, but this doesn't make life any easier. It only makes it more complex, doesn't it, for the taxpayer?
I agree.
So what...
as
go ahead, Divya.
Hello?
Yeah, go ahead. We can hear you.
Something doesn't become easy, even more difficult, as you said, foreign travel. They're asking are significant. You know, for example, what they're looking at is the country's travel, times visited, expenses incurred from own sources in respect of travel. So this is just.
Divya, you know, unfortunately, I'm going to have to let you go on this line because we seem to have caught you on a bad line. We can't really understand very clearly what you're saying. We'll try and reconnect with you, but just to take our viewers through some of the changes, and these are important changes that Sapna was taking us through, the changes to the income tax return forms. Individuals will now have to declare income from foreign assets in the new return form. Owners, beneficial owners and beneficiaries will also have to declare income from foreign assets. Details of foreign travel with expenses incurred will also have to be reported in the tax return. Divya, I don't know if we have you on a better line, but what to your mind is the most contentious of the changes that the government has now notified?
See, I'll tell you, the idea of the government, the way it looks is in line with what they came out with the foreign disclosure bill for the foreign assets or unreported income. They are trying to get more and more details to see that are there any incomes which are getting unreported or which are not being offered to tax. So also this to money. So that's why all these details in terms of whether it's for travel or whether it's in terms of bank accounts outside India or bank accounts in India. So that looks like the objective, to gather more and more data.
Yeah, but you know, that I can still understand, Divya, but what do you make of things like details of foreign travel with expenses incurred to be reported in the tax return? I mean, this, this seems to be complicating life and making it just more complex.
I totally agree. This is actually going beyond the line, you know. I think this is something which was never thought of. And back to what there was earlier, you know, you had before this new long back, you had 1/6 criteria where you had foreign travel or you had any assets you had to return irrespective of if you're having any income or not. So I think they're going back into the same old era. So this is something which is totally, I mean, you know, not justifiable at all if you ask me.
Yeah, it doesn't seem like it makes any sense when the government is talking about the ease of doing business and making it easier for income taxpayers. This is only making life more difficult. But appreciate you joining us, Divya, on India Business Hour. Unfortunately, we have you on a bad line. Speaking of tax matters, here's the latest from Nokia's efforts to sell its Chennai plant. The company today told the Delhi High Court that it's received a memorandum of understanding for the sale of its plant and that the offer it currently has is the best. The taxman, though, has thrown a spanner in the works. Ashmit joins us now with what transpired in court. Ashmit, the expectation was that maybe the tax department would give Nokia a break. Clearly, that's not been the case today.
Well, indeed, despite assurances coming in from none other than the Prime Minister himself with respect to attempts to resolve the Nokia tax issue, with attempts to bring that Chennai plant back online, no relief in sight as far as Nokia is concerned. It's made it arguments before the High Court, presenting the fact that it has in fact received a non-binding MOU from an interested party, that it has reached out to a number of prospective buyers, and that this offer is the best valuation that they have received so far as the Chennai plant is concerned. They also went to the extent of saying that, one, they're okay with an independent valuer certified justifying the bona fides of this offer that has been made, one, and two, they were also prepared to make the concession that all the sale proceeds from the plant will be presented, will be parked before the High Court. But the tax department was unmoved. It continued with its earlier position that there was no question of allowing the sale of Chennai plant unless and until Nokia came forward with a bank guarantee of 3,500 crores. And importantly, the tax department made this seem like a concession given that they argued that the draft assessment order has been framed and that the tax bill that Nokia is likely to face will be in the vicinity of 10,000 crore rupees. Now, it is at this stage that the Delhi High Court chose to intervene and made two suggestions to the tax department. One, they said that the tax department should consider the appointment of an independent valuer to certify again the bona fides of the MOU in play, one. The second suggestion, the key suggestion that the Delhi High Court also made to the tax department was that the taxman should be open to the idea of auctioning, taking the auction route for the sale of the Chennai plant with the current MOU price acting as the reserve price. Now, this is something that the tax department will have to get back on, and they will, as of now, be reviewing the current MOU that is in play. But on 23rd of April, that's in the coming week, is when we can expect more clarity on whether or not Nokia can expect any relief from the tax department.
All right, Ashmit, appreciate you joining us with those details. Now, it's an exit that's shocked the Indian publishing business. The publisher of Penguin Random House, Chiki Sarkar, arguably the most well-known face of publishing in India in recent times, has quit the company along with 4 top executives. Pavni Mittal reports that Sarkar may be starting her own publishing house, but we don't have a confirmation on that.
There's change at India's biggest English publishing company. Penguin Random House India's publisher, Chiki Sarkar, unexpectedly quit the company along with 4 top executives, including managing editor R. Sivapriya, senior editor Nandini Mehta, along with Jayashree Mohan and Gavin Morris. And while PRHI has not yet appointed anyone to fill in for her, all editorial decisions will be taken by Editor-in-Chief of Literary, Meru Gokhale, Editor-in-Chief for Commercial and Business, Mili Aishwarya, and Associate Publisher, Udyan Mitra. All 3 will report to the company's CEO, Gaurav Sriganesh. The news of the exit not only shocked the publishing industry but also Penguin Random House India's management, which was at the London Book Fair when Sarkar put in her papers. The team is reportedly headed back to India to take stock of the situation. Chiki Sarkar's stint with Penguin Random House India began in 2006. She was the first editor-in-chief of Random House India, and in 2011, she left to become the publisher of Penguin India, where her father, the co-owner of Anand Bazar Patrika, held a 45% stake. She then took over as the publisher of Penguin Random House India when the two companies merged globally. Arguably the best-known face of Indian publishing industry in recent times, she has been credited for acquiring authors like Ramchandra Guha and Amitabh Ghosh. While Chiki could not be reached for comments on her exit or future plans, sources indicate that she may be starting her own publishing company soon, a move which may lead to more exits of employees as well as authors. In Mumbai, Pavni Mittal.
Well, changes there at Penguin Random House India. On that note, it is time for us to wrap up this edition of India Business Hour. Do remember to tune in to CNBC TV 18 over the weekend, and we'll see you again with the trading action on Monday morning. Till then, goodbye. Thanks for watching.